globally, money managers, they are focusing on the good bit, they are ignoring the bad news. So money managers have really ignored the big sharp drop which came in the Chinese PMI data. In fact, everyone seems to be focusing and talking only about the US jobless claims, which were much lower than what Wall Street was betting on. So why are money managers only focusing on the good part and ignoring all the concerns like China and emerging market currencies? Let's discuss all that and much more with Paul Schulte, Chief Executive Officer and Chairman of Schulte Resaerch. He joins us live from Hong Kong. Paul, good to have you back on ET Now. Thank you for joining us. Paul, I guess my introduction was the question in itself. Why are suddenly money managers only focusing on the good news?
Well, they're only focusing on the good news because the Federal Reserve has done sort of an about-face last week and said basically that they're going to think an awful long time in terms of just how much money they withdraw in terms of tapering. And so there's been a very big shift in sentiment in the Federal Reserve. The European Central Bank is also looking at the inflation numbers, which are approaching zero, and they're saying to themselves, maybe we have freedom here to do some more stimulation. And we have the Bank of England saying the same thing. And we had the Bank of Japan, really letting it rip this week. So we had the central banks of 70% of global GDP, all basically saying, let's go, let's get going here. Plus, Chinese interbank rates are now down to 3.5% again. Chinese interbank rates have normalized. So, in terms of the 5 central banks in the world, we're in pretty bullish territory here because they're aware of how serious the issues are out there in terms of chronic unemployment, low growth, low inflation, and emerging markets that are in deep trouble.
Paul, what's your view then on the Indian currency, that's the rupee, given the kind of risk of political uncertainty that we are dealing with and the recent emerging market contagion when it comes to currencies?
Well, currencies really come from the credit markets, and the credit markets in India, I have to say, if you look at the math, are tapped out. If you include the government debt on the balance sheet of the banks, the loan, the loan part of the balance sheet on the asset side is larger than the deposit, side of the balance sheet by 20 points. So we're looking at a loan to deposit ratio of around 120. And so India and other countries like Brazil and Thailand and other countries in the emerging world, Turkey, are all having a great deal of difficulty growing and extending credit right now because they've tapped out their savings base, and that just means that the credit cycle is over. And when the credit cycle is over, we've seen this time and time again in the last 25 years. Whenever the credit cycle is over, the currencies always get smacked, and growth has to slow down. Credit has to subside. People don't get what they want. People get angry and they throw their governments out. This is what we're seeing all over the emerging world.
Paul, for markets like Turkey, Argentina, fault lines are clearly visible. But if I map the way how macro has progressed for India, India clearly is in a much better state. Do you think India will remain a favorite trade for foreign investors? Because if I map what Indian markets have attracted in the last 3 years, certainly we've got disproportionate amount of allocation. Do you think that disproportionate amount of allocation is here to stay?
I think India is pushing its luck. I think if you add up the current account deficit plus the budget deficit of India, you get a number which is far more severe than Brazil, far more severe than Turkey, far more severe than Argentina, and far more severe than Thailand. And so I think in this score, you've seen a lot of the consequences of that in the currency. the Indian government probably was smart to allow the currency to sort of collapse, because that was the way to let all the pressure out of the system, was through the currency. And so, Brazil's been fighting the currency and has been, just, playing a game that is very unwise, in my opinion. India has just been letting the currency go, which is probably a smart thing to do. But that is going to have, very profound implications this year in the way of, very high inflation. And high inflation is, a very dangerous thing for the middle class. The middle class can get very upset about high inflation. But I got to tell you, the high inflation numbers, I think, are really one of the reasons why the equity market's performing well, relatively well, because equities are seen as an inflation hedge. Equities are seen as a way to account for inflation. Right. So equities become a liquid instrument in order to accommodate the inflation that's going to be coming into the economy because of the devaluation of the currency.
Okay, Paul, good chatting with you. Really appreciate you taking the time out and speaking with us.